Morning, everybody. Wanted to come to you after yesterday's Fed meeting, which I think was really probably the most significant one we've had in several years. It wasn't because they kept rates steady, of course, which was expected. It was all about the SEP, the Summary of Economic Projections, also known as the dot plots. This only happens every 3 months, not every 6-week Fed meeting, but that's where each independent voting member of the Fed puts out basically their thoughts and their beliefs about what GDP, what inflation, what unemployment are going to look like this year, next year, going forward in the longer term. And most importantly, now for the market, what their projections are for the Fed funds rate going out. As you know, about 8 weeks ago, we had a very significant event. The bond bear market, really probably the worst bear market maybe that we've ever had, ended right at the 5% 10-year yield mark. But since then, our Federal Reserve has been really pretty silent about the whole thing. The market itself has started pricing in very aggressive cuts, 5 for next year. And what was really going to be interesting about this Fed meeting is the market had really kind of an expectation of what usually will happen is when the market's doing something that Chairman Powell doesn't like, he'll talk it back the other direction. We kind of figured that we'd have what you might refer to as a hawkish pause. Everyone knew the Fed was going to pause, but we expected the chairman's comments to be on the hawkish side of things, with the 10-year yield having dropped from 5% to just above 4% in a period of only about 7 or 8 weeks. And for the first time, we didn't get that. If you recall back the last time, back in March, April, and May of this year, when we had the banking crisis coming about and the market suddenly started pricing in all these cuts, we took a 10-year yield down to 350, and the Fed was very clear in their comments that you're wrong. We're not going to fight this banking crisis with cuts. We developed other ways to fight crises that aren't just by cutting rates. You've got it wrong, and we're going to hold firm on inflation. And that, of course, sent the market from 3.5 10-year yield all the way to 5% in a span of only about 5 months. So what was really significant here is when we saw the release of the Fed dot plots, they went from 3 weeks ago expecting and pricing in one more hike to getting rid of that hike and actually pricing in 3 easings for 2024 in terms of their expectations. Very significant. Now, that's not the 5 quarter-point easings the market has priced in, but what it really is a Fed rubber stamp of this market move. And now that the Fed has actually come out and put out their SEP, priced in, not really priced in, but put down their projections for 3 cuts next year, they really can't walk it back. Remember, this isn't easing because the economy is slowing or the economy needs more stimulus. This is just taking economic policy from a place that's very restrictive, which is 5.25 to 5.5, to something that's just a little bit less restrictive. So you might think, all right, wow, Chris, does this mean we're going to have lower rates now? We actually already did. That's actually the move that we saw in this last 6 to 8 weeks, where we took a 10-year yield from 5% to actually now having a 3 handle as of this morning, and mortgage rates down 150 basis points in only 8 weeks. That's a significant move. It happens very, very fast. Markets are very forward-looking, so it's not that, hey, the Fed put the rubber stamp on, we're going to have lower rates. We already got the lower rates, and what the Fed has done is just put basically a seal of approval on what the market is already pricing in here. So what does this mean going forward? What it means is that we're going to continue to move toward a more normal market. We might kind of think, what actually is a normal market anymore, right? 2020 certainly wasn't normal. 2021 wasn't normal. This year even wasn't normal, but on the complete opposite extreme. So if you want to kind of take a look at what's a normal market look like, take a look at maybe mid-2018. We had a case where the Fed had hiked up to, I think, 2 3/4, started dropping the Fed funds rate a little bit. It was a very kind of normal market. We had inflation that was under control. Growth was okay. And what's that look like? Well, a normal market then, and what I think a normal market is in general, is Fed funds rate of around 2.5%, a 10-year yield of around 3%, and a par note rate on mortgages, not 0-point rate, but a par note rate, what you can sell something for par and keep the servicing, of about 4.5%. So what's the par note rate now? Actually, as of last week, par note rate on mortgages was 6.5%. So a normal market is 200 basis points in yield lower than we had in terms of mortgage rates just only 1 week ago. We're probably down around 6 1/8 right now. So again, we've made a huge amount of progress in a very short amount of time. And that's, I think, what we can expect for 2024 and 2025 is not a sudden move down there, but a slow normalization of interest rates, both in mortgages as well as treasuries. So the bottom line, again, why I think this was the most significant Fed meeting we've had in years, is the Fed's rubber stamp of acknowledgement that the Fed may not have slayed the inflation beast, but certainly mortally wounded. And we're kind of really putting this nightmare behind us. So at long last, happy holidays, everybody. And let's get ready to roar in 24.